Welcome back, traders. It's been a while since I've watched an ICT lecture. I have 6 in the backlog, so I do have some catching up to do, but I'm gonna go through it in chronological order so it'll be easier to follow any higher time frame analysis. As always, I'll link the original video in the description, and let's get started with this one titled ICT Venom Example May 12th. Hopefully, he'll reveal new details in his Venom model.
Folks, welcome back. I'll do a quick little review on Nasdaq. And recall, we had this fair value gap down here. I told you as long as we're above that, we don't close below it, we will remain bullish. The near-term draw was going to be this swing high in here, and specifically March 26, 2025's high. And then we had the news over the weekend that China and Trump's administration has worked out an agreement. That's not a resolution, okay, but obviously that news was received well. And it built in a premium opening, and something like that, you never want to chase after that and just go straight in and try to be a buyer of it. Always look for some kind of discount, and because we opened below that March 26th high, that would be still a candidate to expect it to draw up into it, but not see much of the gap closure between settlement on Friday and opening here on regular trading hours, Monday morning, 9:30. So this is the next level I'm watching. So we trade up into this bearish order block, and this gap between this candlestick's low, this candlestick's high, that's what I'm denoting. I have it set blue because I want to see it trade above it, come back down in, treat it as an inversion fair value gap, and if it does something like that, I would be expecting these highs to be, basically tackled. If things don't unravel, okay, things can obviously spin out of left field any given moment with all the things that are happening, geopolitical front. So that's what we're seeing this year. Gap risk. Gap risk is where we settled previous day, and then when we open up, or we settled and we open up, or we settled when we open up. So we're seeing lots of big gaps like this, okay? And these big gaps are many times the very mechanisms that's going to slow down the frequency of setups, meaning you have to be a little bit more selective. And that's not a bad thing. It just means that your rate of frequency is probably going to slow down because all of this movement's being done in the gap event. And then you got to be very nimble with what you're looking for intraday. 9:30 should be right there. So we had this big drop down. That's going to be first presented fair value gap there because it has to be 931. So we have this to that. Okay. So that's Monday's first presented fair value gap of the week. And we're going to extend it to the right. And I'm going to border it with a black line like that. Okay, so that denotes it as a specific fair value gap that should extend through the week, and it should be used every time it gets to it until we close out on the last hour trading or the last 30 minutes of trading on Friday. When we see, like on the day when we open up, a huge gap opening, and it'll be shown this way. See that big gap right there? That's 6 p.m. last night, right there. And we got all this business running out the high we were aiming for on the daily chart in our analysis, and then at London open exactly at 3 o'clock in the morning, we get this huge run up here, pumping it up, and then it stays in consolidation. And right at 9:30, to dump it. Here, and made this short-term low, and then went back to first percent fair value gap, sells off, taking the sell side out here. During a time when it's primarily bullish, we're looking for higher prices still. Okay, so we're going to go to a 5-minute chart. I'm going to show you, which will be obvious when we get here. There is this morning's setup right here. So we have that low, taking out the sell side with this stab below it. So right away, whenever I'm looking for a stop run, and I have a bias that's bullish or bearish in this case, told you we've been looking for high prices as long as that daily yellow fair value gap doesn't have a close below it. My interpretation is the market's going to want to go higher. It's going to reach for a discount to premium runs. Like it drops down to a discount to a PD array that is bullish to run to a higher time frame premium array. Okay, so that's why I gave you the higher time frame daily. That's up here. See, that's it. Fair value gap. I told you I want to see it. Try to trade do and turn into an inversion fair value gap. But right now, this is where we're at this morning. 9:30 opening. First percent fair value gap is in here on the 1-minute chart. But this run below that low here is going to be our catalyst for Venom. Do we have a single candle run below the sell side liquidity pool? Yes. Do we have a candle that leaves that low and goes back higher on one singular pass higher? So we have a sell off, at least one minimum number of candles, at least one below, and then leading it. Well, we have 1, 2, and then here we have the big buy side value, sell side efficiency. So we have SIBI, inject the venom, run away from it. So here's the two fangs. Okay, that's the play on words I call for my Venom account or Venom PD array and setup.
Okay, so far higher time frame analysis, we're looking for higher prices, but we can see retracement into this large rally. Now he's looking at the 5-minute chart. Usually he stays on the 1 minute, but when price looks cleaner on the higher time frame, don't be afraid to just bump up the time frame. Remember, price is fractal. If you look at this consolidation here on the 5-minute, it's very, very choppy. If you go down to a 1 minute here, you may think, oh, it looks cleaner, I can see setups, but price is not going to break out of this consolidation as long as the 5-minute looks this way. You're just going to get up and down, choppy condition, and it's not going to break out of the range. Now, talking about Venom, if you remember from previous videos, he mentioned the stop loss should be below 50% of the second fair value gap or the second fang. However, if you did this here, you'll probably get stopped out. In my opinion, I think you should have your stop at the very least at the low of the fair value gap candle. If you want to be more conservative, you can have it at the low of the order block. But what do I know? This is not my model. I wonder if ICT will mention any of this.
The criteria is we're going to be a buyer, but we have to be a buyer at the opening price here on that fang or less. Okay, and there's that. So we have to be a buyer at that price or less. Look how much time it spent in distortion. That's what this is, time distortion. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. 17 candlesticks over an hour just sitting in there, just banging around, not doing much of anything with these small little ranges here. But the range high from here to here, you can clearly see there's an equilibrium price point that it worked off of. See, it's just hovering around that. So that price is just the consolidation of all this garbage type price action, which is meant to wear you out. Traders are not going to see this as an obvious long. They're not going to see this as an obvious short because it stays here and it frustrates them. So what you have to do is you have to submit to something and stick to it. So this candlestick's low is risk, and this candlestick or less is an entry for this Venom model. Okay, so I'm going to show you the entry. There's that, and it was just simply me looking at where we're at in this range and not worrying about it because the stop needs to be below here, and there is the entries right there. So it's inside this candlestick's close and less right there. Here it is right there. Okay, and getting out on the high candle as it pokes above this high and this sell side balance, buy side efficiency, aiming for that. There's my exit right there. Okay. There you go. And let's go into a 1 minute chart and you see the details through that perspective real quick. Okay, and you can see how it used the first fair value gap in the 315 and 345 macro. Final hour trading. And here's that sell side. Runs below, leaves it. Now, if I was going to use the 1 minute chart, I would have the benefit of looking for an opening of a new long position at that closing price or less, which would have been offered to me here. May have missed it on here, let's just be fair. It may not have given it to me here, but I had several opportunities here, and then it starts running away at the lunch hour, noon. Okay. So this is what wears traders out. And whenever you see price going sideways, you're going to have to toggle up. Okay, go up a time frame or two. So my time frames are obviously 1 minute, and then jumps to a 5, then 15, and an hourly. But if there's a whole lot of candles on the 15, I might go to the 30-minute first before going into the hourly and see if there's any refinement between the levels and PD arrays seen between 60 minutes and 30 minutes. But generally, that's the hierarchy of where I go to before I get to a 4-hour and daily chart. But this kind of stuff wears people out. Okay, and you're just gonna have to bite the bullet and say, okay, I'm willing to assume the trade and get in at the price that makes sense. I saw the setup. The Venom model is on the 5-minute chart, so that's the reason why I framed it with the 5-minute candlestick for liquidity purposes. Running my stop down below the candlestick that pierces back above the low at target. So again, same thing. Drops down, injects the Venom into sell stops here, accumulates those sell stops, and then breaks higher. You have to have a SIBI first, and then a BISI leaving it, or it's not a Venom. You got to enter below the second candle closing price, or it's not a Venom. Okay, and ultimately the price starts to run up, as I mentioned. Beautiful, beautiful delivery to the first resistance fair value gap of this morning, and it's Monday, so it's the first resistance fair value gap of the week. So you want to make sure you denote your first one of the week like this, so it kind of stands out no matter what. And then it runs up in, there's the X right there. So just a really nice little wait and see. Wait until it gets down to a discount range. Wait for the sell off when you're bullish. Look for your entry models. And if you were not going to use the Venom type model in here, you could have used a inversion fair value gap right here. You draw that one out with this candlestick's low, sorry. This candlestick's high. Extend it out in time. And you want to see price start to rally up, and you can see it right there. And I'll draw it out right now. So you have to defer your entry until a time that the market's proven to you that it has turned around.
Alright, so now he says the stop should be below the second Fangs candle, which is not consistent with what he said initially. But in the first Venom video, I did say the stop should be below the fair value gap. Go back and watch that video and you'll hear me talk about where I think the stop should be. So gonna continue with the lecture, but note what he says about extending the first fair value gap through the entire week. We'll see if he uses this fair value gap again in future lectures.
All right, so here we had this consolidation. Wait for it to lead the consolidation, prove it's moving higher. That's displacement here, trading above this high. We're not a breakout trader. It just tells us it's done the damage down here. Now we're seeing the market go back above old areas of where people would trust that as resistance. Trades above it, comes back down, lower quadrant of this, which is drawn incorrectly. All right, so we can see that the market eventually trades above it, comes back down in lower quadrant. Look at the bodies. See what this is doing right here? The bodies are telling you the narrative now. We traded in the upper half. Any wicks are just allowing the market to take individual that trail stop losses up. They're allowed to do the damage. So the bodies are telling you, okay, we're not staying down there. So it leaves, comes back down in. Then this should be what? Not willing to go back down to the lower half. Now you can do several things in here. You can use the volume imbalance in here as an entry there, and then or this was your catalyst saying, okay, we are now turning higher, so now we can attack these relative equal highs over here into the PM session. Use the first fair value gap as a long here, rallies on up into another consolidation. That high is going to get tagged. Boom, there you go. So there's an approach of using today's price action with my first fair value gap, and also waiting for a structural shift where it's gone down, disrupting anyone that's long or entice people to be short, and then it comes up and cleans their clock. My entry was just simply just getting in, trusting that the information that I've outlined thus far as it relates to the Venom model would stand true, and you can see it tested out. You go in here on YouTube channel and look up Venom example, and you'll see me explain what I just showed you here. It's just another form of using a deferred entry on a turtle suit long or turtle suit short. You don't have to be in there where the actual stop hunt is occurring. Wait for the market to give it to you with the Venom model, and then it's like taking candy from a baby. And ultimately here, nice run. Look at that. You got to admit, folks, I mean, this is brilliant. Until I taught you the first fair value gap, these types of runs in the PM session, completely oblivious. You didn't know anything about it. I am a nice guy, aren't I? Humble too. Listen to me. All right, so 1:30 to, it's just the character, folks. Don't get wrapped up in it. 1:30 to 2 o'clock. Right there. That's your range. You want to look through and find your first percentage fair value gap, and then extend that forward into here. And you'll see something that will be beneficial for your journaling. I'm not showing you everything. Otherwise, there's no point for you to go into your charts. Between 1:30 and 2 o'clock Eastern time, first fair value gap, extend it forward, and you'll have another opportunity to study for the PM session, short or long.
Okay, so that's it for this lecture. I would say this one is below average from what he normally presents, but I do have two takeaways. First is moving up a time frame when things look unclear or price action is choppy. It can make things more clear and you won't get exhausted with the chop. Second is to extend that first presented fair value gap on Monday throughout the whole week. We'll see if he actually uses this later on, but from this example, you can see that price does use it in the PM session at 345 to rally into the close. So that's it. I hope you find this one insightful. Please give this video a like and subscribe, and until I see you next time, safe trading.